Hey everyone, it's Sarah Maslowski with Moving to Georgia, your North Metro Atlanta real estate agent with KeyPoint Homes Group. I'm excited to be here with you today because, boy, there has been a lot of news that has happened since the last time we've had a chance to get together. And if you're in the market right now and you're a buyer, I have some good news for you because looks like they're turning around just a bit. And I've got a special guest that's joining us tonight. It's our favorite lender, John Birchfield. Welcome, John.
Hey, Sarah. Thanks for having me. Good to be
Yeah.
here.
Awesome. So tell us the good news. What's going
The
on?
good news is rates are dropping. Finally. Finally. It feels
Yes.
like we've been waiting on this forever. Certainly expected this probably around this time last year. So I feel like we're
Right.
about 12 months behind, but I think this is the first significant move in interest rates we've seen really since they started going up back in 2002.
I feel like all the videos I've made for the past year, it's like, well, they're projected to go down. They're projected to go down. And then we just keep moving the field goal. And
Yeah,
now it feels like, okay,
we're
what they're
here.
saying may actually turn out to be true. So
Yeah.
what's driving the drop in interest rates?
Yeah, well, it's a couple things, but the way to sum it up best is that the evidence is becoming clear that the economy is slowing down, right? Because what made interest rates go up was that the economy overheated through all the stimulus money that was given out during the COVID years and having 0% interest rates effectively during the COVID years caused rampant inflation and caused an overheated economy. And we paid for that with high interest rates for a few years. And now we're seeing the results of that work that had been done to monetary policy to cool the economy. And that's happening. We're seeing slower growth and we're seeing, more importantly, unemployment tick up. And that's a key factor in what's driving interest rates lower.
So it's kind of counterintuitive that it's almost like bad news equals good news.
I know it feels weird to say, somebody lost their job and that causes interest rates to get better. Like that doesn't seem
Right.
fair, but that's the reality of it because what what drives the investment into fixed income securities like treasuries and bonds and mortgage backed securities is the thought process that the economy is slowing down. So your traditional companies to invest in may not earn as much income. And if they're not earning as much income, we don't want to invest in them as much. We want to invest in things that we can predict and know exactly what we're going to get in yield on our investment. And that
That
causes
makes
interest
sense
rates
from
to go
that
down.
perspective. Okay.
Yeah.
If you're just joining us for the live stream, welcome. Let me know where you're watching from. And if you have any questions, the market, have any questions for John tonight, go ahead and drop those in the comments and we'll make sure to get those questions answered for you today. I know that I have a bunch of questions that I fielded from clients that we're working with over the past couple of weeks that I'm sure a lot of people watching right now will also have questions on. So we'll get to that. Tell me a little bit about where mortgage rates were and
Mhm.
what we're seeing today.
Yeah. So, really since about November of last year, think the presidential election, because that was kind of a key turning point. We saw interest rates go up to the low sevens for most folks. Sometimes it would dip into the high sixes, but right in that range. And we kind of stayed there through the first half of this year. And the economic data that I had mentioned earlier that shows the economy is slowing started to trickle in July. So that's when we started seeing this slow tick down. And then there was an employment report that came out I don't know, it's probably about 3 weeks ago now, that revised all the employment data that had come in through the first half of the year much, much lower. So kind of all that data that kept interest rates fairly stagnant during the first half of the year was revised and says, that was all bad data. It was really much worse than we had anticipated or even knew about. And that caused interest rates to start this steep decline that we've seen through the months of August and the first few weeks of September.
So what do interest rates look like today if someone was in the market for a
Most folks are
loan?
locking in now in the low sixes. So we're seeing, and this is a typical conventional type mortgage, is going to low in the low sixes. We're seeing FHA and VA interest rates get into the mid to high fives. So That's really exciting when you're sitting
Yeah,
in my
that's
seats.
significant.
It's huge. I mean, it makes a home so much more affordable for folks than what we saw when those interest rates were in the low sevens.
So this isn't perfect numbers, but I put this together with the help of AI, looking at just principal and interest. If we qualified for, let's say, a $500,000 house last year at a 7% interest rate, assuming we're putting 10% down, our monthly
Mhm.
payment just in principal and interest would have been close to $3,000.
Yeah.
That same house, same down payment, this time around 6.25, that we were looking at $2,700 a month. So that's saving us $223 every single month. And that adds up significantly over the course of the lifetime of that loan. So that's significant savings that a family is saving every single year. That's more than what, $2,400 a year, right?
Yeah, we're about
Yes.
$3,000 a year,
Right.
is what you're doing with. So that, yeah, that's huge. I mean, that's, and where I think the power, where we really see the power of that from where I sit is so many folks had been kind of priced out of the market, right? So,
Right.
they may call me and I say, hey, when interest rates were 7%, they only qualified for a $300,000 home. And if they're, a family with 3 kids, and depending on what part of town they're looking in, that could have been a real challenge. And now we're able to go with that same buyer and maybe able to get them approved for 350 or 360. And that
And
can make
keep that
all the
payment the
difference in the
same.
world, and keep the payment the same as what we've been talking about. And
Right.
that's where I get really encouraged, because now it gets people back into the market and being able to find the home that their family really needs, as opposed to having to settle for something that doesn't work, or getting frustrated and just not being able to buy at all.
Yeah. So I think the huge significance of this in this moment of time right now, in this unique little window that we're in, from what I'm seeing on the real estate side, is the market, the summer that we had wasn't what the market wanted, or wasn't what sellers wanted. And so
Yeah.
there's a lot of inventory that's been sitting on the market. Typically, what we're seeing with sellers that have their house listed for sale right now, it's because they have to sell. I just met with some sellers who are going to the market this week. They're selling because they're relocating for a job. Very rarely are we, not rarely, but occasionally we get people that are selling just because they want to sell, but most people are selling because they need to. And so these people have had their houses on the market. They keep lowering the price and nothing's happening, or they thought they could get what they wanted. And so we're able to come in and negotiate some really good deals relatively
Right.
from what we've seen last year and the year before. And so coupled that, because that's still the reality for sellers right now, because we haven't had this flood of return of buyers, which we may.
Yep.
But right now they're not out there. So you're getting kind of like the best of both worlds. You're catching up with the bad market for the sellers, and you're getting good news from mortgage rates.
Yeah, I couldn't agree more, because I think you sense and I sense, just based on the volume of folks that I've spoken to over the last 18 months who really wanted to buy, who really needed to buy, but just made a decision to hold off because of where interest rates were. And I know that those buyers are going to come back to the market when the media catches up to the reality of where interest rates are now. And when they come back to the market, yeah, that's going to put upward pressure on those prices, or at least you're not going to be able to get the incentives, the closing costs being paid by the seller, maybe multiple offer situations where you've got to bid even over asking, like we saw. I wouldn't be surprised if we see that as we move in through the next 6 months or so.
Yeah, totally agree. I see the spring market being completely different if these mortgage rates hold steady,
Yeah.
because this is kind of, the light at the end of the tunnel, or the good news that a lot of buyers, like you said, were waiting for and hoping for,
Yeah.
to see. There's a lot of talk in the media right now about the Fed meeting in September and how that's going to affect rates, and kind of like the
Yeah.
headlines are, that's going to have a positive impact. Explain to viewers who are hearing that, and why maybe it's not best to wait till then.
Yeah. This is a good one. This is a good
Yeah.
one, because the first thing to know is that anything that the Fed does next week, That's already priced into today's rate sheets. In fact, that was priced into today's rate sheets a month ago, right? Because mortgages know that, the people who price out and deal in these mortgage-backed securities, they understand what the Fed was going to do. We all know they're going to lower interest rates. So they've already priced that in to the interest rate sheets. Now, here's where things are going to get complicated, is that, to your point, the media is going to come out next week and say the Fed finally lowers interest rates. And the perception amongst the public is now my interest rate is going to be 0.25% better. So the buyers will come out of the closets and say, okay, give me a mortgage. Let's find a house. And that's great. But the reality is quite different. It is often the case, about 80% of the time, that we see the Fed lower interest rates, mortgage rates actually tick up just a little bit. Okay. And the reason for that is because, why is the Fed lowering interest rates? The Fed is lowering interest rates to stimulate the economy. Well, we just talked about what creates low mortgage rates: bad economy, right? So if bad economy creates low mortgage rates, and the Fed is doing something to stimulate the economy, the expectation is that maybe we'll have a little bit hotter of an economy, and therefore we might have a little bit higher mortgage rates. Now, these are tiny shifts, right? It's not anything drastic. We're not going to go from 6.25 to back to 7s. I wouldn't expect that. But if you could lock in at 6.25 today, could you see 6 3/8 right after the Fed makes a move? Probably pretty likely that might be the case, because what the market's going to then do is wait on more data, right? Because the Fed's going to make a move. And to be clear, the Fed is adjusting the overnight federal funds rate. It's what banks are able to borrow money from the Fed for. What do the banks pay interest on the money Fed? Not the actual day-to-day consumer. Although it does trickle down to credit cards and everything else. But circling back, to get too stuck in the weeds, when the Fed lowers those interest rates, the market is going to want to see more data. What was the effect of that lowering of the Fed funds rate? Did it stimulate the economy? Maybe did it stimulate it too much? Or was it not enough? And do we expect additional easing in monetary policy from the Fed because the economy is still cooling, unemployment is still rising? That would cause interest rates to continue to go down.
Got it. Kind of.
Yeah. And we won't know that for a while.
Right.
It'll probably take until December before we start to see any type of market data that's representative of what's going to happen next week by the Fed.
So barring anything happening globally or that something unknown that we don't see on the horizon right now, is it kind of safe to say that we may be living in this low 6s through the end of the year until more economic reports come out on jobs, inflation, that sort of thing?
That's what I would expect. I would expect that we're probably where we are. It may be even longer than that. Again, depending on what that data starts to show a few months after the Fed move. But probably stay pretty close to where we are now. And then maybe see a move one way or the other as we enter the first quarter of next year.
So in practicality, the conversation that you and I had on Monday is we have some clients right now that are under contract on a new construction home. They had not yet locked in their interest rate. And I think that was on the advice of you, because you knew that rates were kind of moving down and that they would benefit from waiting a little bit longer. I think the numbers that we ran for them is that they were ultimately saving between $130, $150 every single month if they would have locked in on Monday, comparatively to where we were 6 weeks ago.
Yeah. Well, I think it was even less than that. It was about 2 weeks when we actually started their loan process. I think it was the $130 difference. Back when they started the home shopping process, it was even more so. It probably would have been in the neighborhood of $300 difference from when they actually started home shopping to what they can lock in on now.
Yeah. So the takeaway for you here at home, if you're watching, is if you were pre-approved anything more than 2 weeks ago, it's well worth your while to go back, even if it was 6 months, 9 months ago, a year ago, and to ask your lender to, give you an updated quote based off of today's rates to kind of see, does that move the needle for you or provide enough relief or help you meet your financial goals of whatever stopped you from being able to move forward last time, this time? Because there's there's a lot of good phone calls I was able to make and say, hey, let's revisit this conversation.
Yeah. Yeah. That's very good advice.
So with that, are discount points still a good idea? I know for the past year and a half, I've talked a lot about this on the channel of how we can, get some seller concessions. We can buy down the interest rate to make it, more appealing. So where do we go with that today?
That's a great question. I'm actually pulling up a chart that I just referenced earlier today. Discount points may be even more valuable now than they were. And the reason for that is,
I guess let's set the stage just in case someone doesn't know what a discount point is.
Oh, good idea. Yeah. Discount points are extra fees that a buyer may choose to pay at closing, extra closing cost that is being used to permanently buy down their interest rate. Okay. In general rule of thumb, one discount point, which is equal to 1% of the loan amount, can buy the interest rate down about 1/4%. Okay. So if interest rates were 6.25% today, general rule of thumb, it changes, but 1% could get you to 6%. Okay. And then we weigh out, okay, does that make sense for you? Does that help you accomplish your goals and getting that payment where you're comfortable? But why is it a good idea now? Maybe more so, because one of the things that provides like a governor to how quickly interest rates can go down is the idea of fast prepayment speeds. Okay. The market is funding 30-year mortgages. Well, they're expecting to yield a certain profit off of funding that mortgage, right? And they usually expect to earn a profit of somewhere between 7 and 10 years of interest payments on that mortgage, because that's statistically mortgages last between 7 and 10 years. Yeah.
Got it.
Before they sell it, before the loan pays off some way, somehow.
Right. Yeah.
Right. But if we're in a market where interest rates are expected to go down like we are now, or they're going down fairly quickly like we are now, mortgage rates might slide further faster, except for that key point that an investor is saying, hey, I don't want to fund a 6% loan today when I funded a 6.25% yesterday, because that 6.25% I funded yesterday may refinance. Cut off my phone here. May refinance. And then I lost all that money. I didn't get the return on my investment that I made yesterday. Okay.
You didn't get the 7 to 10 years of interest because they've refinanced it, paid it off.
It paid off too early. So I lost my butt yesterday. So if I'm losing my butt yesterday on the investment that I made, I got to make up for it today. How do I make up for it today? Slightly higher interest rate. I can't get as low as the market might otherwise dictate, because I got to make up for the losses for all the loans on my portfolio that are paying off too early. All right. Okay. Now, all that is just to say that discount points can combat that, because what the investor is going to want is money right now, right? So the discount points can have a wider margin. So I just mentioned, typically 1 point might only get you 1/4% reduction in rate. When you're in a market like today and looking at some charts, one discount point could go 3/8 of a point. You could go from 6.25% to 5.8.
So that discount point, from an investor standpoint, that's immediate interest payment money that they're getting up front. Yep. So it's immediate money. And so if
they don't have to worry about it prepaying. Yeah.
Not only that, we've already captured some money.
I've already got some profit. in the bank. And not only that, but now you brought your interest rate down to 5.8. So now they know that the market has to move to 5.2 or 5 or 4.8 before you refinance and pay off early.
Got it.
Statistically, that loan is likely to not pay off as early as one that didn't pay discount points and just took the 6.25.
Okay. Don't know that I ever understood it like that before, but now I do. So that's good.
Yeah. I'm totally geeking out on these numbers.
Yeah. So if you're joining us and you have questions, let us know. Put those in the comments. We want to make sure that we answer. It doesn't have to be for John. If you just have questions about the housing market, anything that you want to talk about, let us know in the comments there. One of the articles, as I was researching it today, stated that it might be a good idea for buyers to consider an adjustable rate mortgage. Is that true? What are you seeing with rates for ARMs?
I don't think we're quite there yet, but we're getting there. We're getting there. And just the backstory here is when interest rates went up, when the Fed was lowering short-term rates, short-term, think ARMs, right? And fixed rates were here, it kind of compressed that so that interest rate arms and fixed got pretty close together. There wasn't that big of a difference between them. And there for a little while, arms were even higher than fixed rates because of how aggressive the Fed was in increasing the Fed funds rate. But now that the Fed's lowering rates, and we talked about all the factors that go into limiting how fast the fixed rates can come down, that gap between the two grows. And we're seeing it grow, I would say, pretty significantly. I looked at a 7-year ARM today, and you could secure 5.8% on a 7-year ARM, and that locks the interest rate in for 7 years before it ever starts adjusting, right? And that's 3/8 of a point better than a 30-year fixed. So that's pretty significant.
So in practicality, where that shows up, I'm thinking about myself. We used to move around quite a bit for my husband's job. We knew that we only ever lived somewhere for 3 years before we moved someplace else.
Yep.
And so if we were in that same situation today, and I knew that I was going somewhere, and likely the longest we would be somewhere would be 3 to 5 years before we make a move, an adjustable rate mortgage would be incredibly low risk for us because we're selling that way before that 7-year, 8-year term comes up where it would actually adjust.
You got it. That's exactly when an adjustable rate mortgage could be very beneficial. The other scenarios, if you just wanted to gamble that rates continue to decline, so that at some point you're going to want to refinance your mortgage regardless, so that you might as well take care of the savings now, and that know that sometime within the next 7 years, you could always refinance.
Right. What are we seeing for second homes, investment properties? Are those getting any better, or still kind of hovering around where they've been?
They're better, but I'm still a little frustrated with how investment properties and second homes are priced out in today's world, because the spread between a typical owner occupied transaction and investment in second home, again, it used to be, just 4 to 5 years ago, it was like this, right? There was a difference, but not much. And it's still like this. So if your traditional owner occupied mortgages are running, say, 6.25%, you're probably going to expect to be 6.8 or so for an investment property. It may be 6.7 for a second home.
And why is that? Like the
agencies, Fannie Mae and Freddie Mac, made a decision about, I don't know, 4 or 5 years ago. They made a decision that they wanted to protect Fannie and Freddie's interest to be available and as low cost as possible for somebody to buy a home. And I applaud that, right? That's their purpose. As a government secured entity, that's their purpose. But in doing so, they says, well, we shouldn't necessarily reward folks that are just buying a vacation home or buying an investment property. So they increased what they call the loan level price adjustments associated with those types of mortgages that are funded. So they made investors and second home buyers pay more to hopefully protect and make mortgages lower cost for folks that were buying their primary residence.
Okay. That makes sense.
Yeah.
Kind of.
Yeah. I just don't know that it worked. I don't know that it made it lower cost, right? And from a risk management standpoint, you see that, you see that investment property loans perform incredibly well. You see second home vacation perform very, very well. So it was a little bit of just kind of a stick it to them kind of move, and maybe a little bit of a money grab. But in theory, it made sense.
Got it. So I think Jean was just joining us from the top of the live stream. But interest rates are like 6.25%, 6.3%, depending upon for conventional loans, right?
That's right. Yep.
And
that's with no points, without paying anything extra.
Comparatively to 7%, high 6s where they were earlier in the year, and the if you're doing like a FHA loan, which is where you put 3.5% down, rates are even a little bit better there, right?
Yeah, we're seeing like 5.6 for FHA loans.
That's really cool. So one of the things I love about sending clients to you is that oftentimes I get this question, and you would just think like, okay, well, if I can qualify for that 5.6, that's sure a heck of a lot better than 6.25. Doesn't it just make sense to do an FHA loan? And one of the things that you do for clients is you run both of those scenarios for them and kind of give them the nuts and bolts so that we can kind of compare things apples to apples and go through the pros and cons of what that actually looks like in reality, right?
Right. Yeah, because there are some disadvantages to FHA. I mean, the reason that the interest rate is better is because you're also paying an insurance policy to be a member of FHA's club. You're paying FHA mortgage insurance monthly for the entire life of the loan. It never goes anywhere, regardless of how much you pay the loan balance down. That is going to equal to about 0.8% of the loan balance every year. So 0.8% annually, that really adds up. And that's on top of an upfront fee that they charge at closing that's equal to 1.75% of the loan amount. Now, they do let you finance that. They include it in the loan amount. You don't have to come up with that in cold, hard cash, but it's still a factor that we've got to talk about because the lower interest rate doesn't always mean that it's the best mortgage.
So but on the flip side, or the pro side for FHA, is that you only have to put down 3.5%.
Exactly.
And your debt to income ratios can be a little bit higher. So depending upon what your complete financial picture may look like, it could be a good way to get into a house, to make it more affordable, to get in there, start building some equity. And the great thing is that they can refinance into a traditional conventional loan.
Yeah. FHA is a phenomenal way to buy your first home for certain, right? If I don't have a lot of cash to put down, I'm immediately looking for FHA because that lowest interest rates, very flexible underwriting criteria, very minimum down payment required. We even have several government assistance programs that we can partner with that can help fund the 3.5% that's required for FHA. So a lot of flexibility to help people buy a home, but you don't have to be a first-time home buyer.
Right. Yeah. I remember that's how we bought our first house, was with an FHA loan.
Yeah, me too, I think.
Yeah. Just scraping together those pennies.
I know, right?
Takes a lot more pennies in today's market.
It sure does.
Okay, let's look at so just to go back to Jean's point, this is like if we were looking at a $400,000 mortgage between 7%, 6.29%, that's about $187 a month saving in your principal and interest. So again, that adds up quite a bit every single month, year, and especially, if you look at that 5-year term that you may be paying interest before you refinance that or pay off the loan or sell, that's a significant amount of money that you're going to be saving. Let's talk about the housing market, though, what we're seeing. So this was an interesting stat to me. Almost half of homes across the nation are selling below asking price. So overall, buyers are in a much better position than they've ever been before with homes and can negotiate much more. I pulled the stats here for the areas that we serve quite a bit. And we're looking at between, 26% all the way up to 35% of homes that are currently on the market are having their prices cut. And so this is significant because just because they're cutting their price doesn't mean that they're still getting that full asking price. So oftentimes we can come in and negotiate more or get the seller to pay closing costs so that then we can buy discount points and get an even better rate that's giving you more of a payoff. There's lots of different ways that we can, finagle this for you. So there's a lot of opportunity, and it used to be that we would maybe see a little bit more opportunity in Gainesville or, maybe in Brazelton, but we're kind of seeing it a little bit across the board now in really popular towns like Alpharetta and Cumming. So great opportunities right now for buyers that are out there.
Yeah, that is a really encouraging graph for buyers, because I would agree with you. If they're already cutting the price on the home, it's for what the advertised price for the home, and then you're able to negotiate even beyond that. Which on almost every contract we're seeing some type of buyer incentives built into the deal. That is probably the best scenario I can remember seeing for a buyer going back probably to 2017, 18. So I think, you're holding the deck of cards, or you're holding the aces, right? As a buyer in the whole negotiating process, probably for the first time in 6 years.
So I think I would go as far to say that for all the clients, people that I've talked to over the past 2 years that were waiting for a good deal, I think like now's that time.
Yeah.
I think this could be the window of opportunity for that good deal, even though it may not feel like a great deal or a good deal. But in relative, like if you bookend this with, 23, 24, and then likely what's ahead, this is going to be that window of time for that good deal.
Yeah. I hear from so many folks, oh my gosh, if I had only bought a house in 2021. And I'm like, I'm telling you, you're gonna wake up in 2020, 2030 and say, if only I'd have bought a house in 2025. Right.
Yeah.
So there's no other, regardless of up markets, down markets, the statistics bear out that there's no better way to create wealth in our American system other than acquiring real estate. Okay. Because you have to have a place to live. And if you can lock in on a fixed cost for what it's costing you to live in that home, knowing that most likely over the long term that the home value is going to appreciate, your mortgage balance is going to go down, your income is going to go up, but your mortgage payment stays the same. So it may be a real burden now. This is how I would coach a new home buyer, is that that payment's probably going to be a burden over the first 2, 3, 5 years. But don't think short term. Think about how this is going to change your financial future for decades.
I read a article and saw some videos on this that was essentially kind of saying that they feel like the author's point of view was that if you didn't buy a home prior to 2021, that you're essentially priced out of the market forever now. And their standpoint was, with the way that incomes are today, where inflation is, how much rents are, how much your household expenses are, and what little is left over for savings, that it's almost impossible. I mean, obviously it's not impossible. A lot of times you got to do dual income, or maybe sometimes you're getting your parents to help co-sign, or living in mom's basement for a while, or, whatever, to kind of pull all these resources together. But the traditional ways of the American dream of being able to buy a house, that it's largely gone, because the way that most people have built that wealth and they're able to move up in these houses is because they've made all that money on the sale of previous homes and gotten out that equity. But if you're never given that opportunity to start in the first place, it makes it incredibly difficult. And so my takeaway from that and listening to that perspective was, buying a house right now may not feel good.
Yeah.
It may be drastically different than the picture of what you had in your head of what your first home was going to be like. Yeah. And I even see that today when I'm with clients, looking at houses, and in my mind, I'm like, wow, this is drastically different than what an entry-level house would have been 5 years ago. And yet it's still a good investment because it's something that's necessary to get, like you said, to the next spot. And it's not going to be that forever home. But unfortunately, if home ownership is something that you want, it's almost like working that first job out of college to, get your grunt work in and build up your resume. This is building up your, financial resume by having something that you can. Yeah.
Yeah, that's a great analogy. And I agree with the sentiment of the author that you were speaking to in general. And it's very sad to talk to people and when they just see the struggle that it's going to be to buy their first home. But my encouragement is always yes, it's going to be tough. It's going to be tougher than your parents had it. It's going to be tougher than your older siblings may have had it, but it's still worth it. Right.
Yeah.
It just takes maybe more sacrifices to accomplish your goals, but it's still going to be worth it. Still believe that.
So kind of along those same lines, another rabbit hole that I fell down into the other day, and I'm sure you've had this thought too, as you're driving around the metro Atlanta area, it feels like every time you see land being cleared, it's like 1 or 2 things going up. 3 things. A new neighborhood.
Yeah.
More apartments. Or storage units.
Storage facility. I knew it.
Yes.
Yes.
And I was like,
or an Amazon
why?
warehouse. It might be an Amazon
Correct.
warehouse.
Or yes, or a logistics center. It's one of those four things.
Yeah.
And I was like, why are there so many storage places popping up? And obviously, I know people need a place to store their belongings, but it just doesn't make sense from a practical standpoint in my mind. So what I learned from this is that Atlanta, the metro Atlanta area, is fourth in the nation for apartment growth, of how many apartment units that they're building. And it's to answer the supply and demand that's needed. Apartments themselves are getting smaller because they're wanting to maximize all the things. Therefore, you need storage space. Atlanta, metro Atlanta, comparatively to other metros across the United States, we still have less square foot per capita than other markets. So even though it feels like we have a ton, we're still far behind other metro Atlanta areas for the amount of storage space that other places have available
Really?
already for rent.
Wow.
Yes. And they're about to increase the amount of storage facilities that's going to be available for rent by 7% comparatively to what's currently out there just within the next year of stuff that's already under construction. So overall, that speaks to the fact of apartment builders are building all these apartments because they feel like long term they may see you always being a renter. That's kind of the takeaway that I took out, because you got to live somewhere, right? You have to house people. And once you get to that stage in life, you're either renting or you're buying a house.
Yeah, I think that's accurate. And they see the population growth, especially in the Southeast,
Right.
that they're expecting there to continue to be this mass influx of people moving here from out West or the Northeast to enjoy Georgia and all the opportunities that there are here, which we've had other live chats about. So yeah, I think they're very forward thinking and knowing that. And and these 700 and 800 square feet apartments, it often doesn't have room for all the stuff that we like to collect. So you need a storage building to shove it in. I've also heard the storage building craze is because we do have an aging population. So you've got a lot of retirees that want to move down or move into, senior living centers or 55 and up neighborhoods where often the space is a lot smaller than the big house they raise their kids in, but they don't want to get rid of their stuff.
Yeah. So if you're not following me on Instagram, go follow me over there at Sarah Maslowski. You'll see a new reel coming to you soon, breaking down the storage unit facilities all over the metro Atlanta and why you will see so many of those. But lots of good information out there highlighting businesses and new developments that are coming out. Feels like just about every single day. So I personally like to see the growth and development around here. I view it as something that's inevitable. And there's a lot of local people that feel a little bit differently.
Yeah, I can see if you've been, especially, I mean, you and I both live in the same county, Hall County, and it, I've got neighbors that have been here for, 30 years and 40 years, and they can get a little discouraged about how it's changed, and I can appreciate their viewpoint. But I heard once, if you're not growing, you're dying, right? And that's kind of what it feels like. Progress is always a good thing. And that's what it feels like. Certainly our county, Hall County, is going through a major growth spurt right now.
Yeah, for sure. One big thing that we're seeing in the real estate industry is that builders are offering some pretty darn good incentives right now. And that kind of speaks a little bit to the growth and development that's happening here. There's tons of new construction opportunities all around. And these builders have, sitting inventory that they need to move. And so nationwide, we're seeing, 2/3 of builders are now offering incentives on just about every single house that they sell. Also, if you're in the market for new construction, typically those incentives get a little bit more aggressive towards the end of the year because they want to get those houses off of their books and don't want to carry them into 2026. Because when you're looking for a new construction home in 2026, you're going to be searching for 2026 or greater, not necessarily 2025 in your search results. So that's another factor that they don't want to carry over that previous year inventory. So there's a lot of good opportunity for buyers out there right now in the market.
Yeah, big time. And I would agree with your point about the end of the year sales that builders have. A lot of builders, especially your national publicly traded builders, if their fiscal year ends on December 31st, they have a big, strong incentive to their shareholders to make sure that they don't have standing inventory when they close out their books for the years. So you can see some major deals be had to get under contract and closed before December 31st.
Yes. Yeah, for sure. One of the things that we're seeing here locally in the market with resale houses or homes are, spending a little bit more time on the market. This is looking at percentage of growth year over year. So on average, we're seeing homes spend about 25 to 35% more time on the market compared to last year. So it just means it's taking these homes longer to sell, which goes back to the price cuts that we talked about earlier. Obviously, if they're not selling, then outside of improving the condition of the house, the only thing that you have to finagle is that price. And so that those two things kind of play hand in hand that just, again, speak to what an opportunity buyers have right now in today's market.
I would have never guessed that Alpharetta and Swanee would lead that list. That's fascinating.
Yes. And, I'm sure there's some outliers here too, because home prices there, median home price, I think I have that in the next one. Yeah. Those are the two highest median home prices. And, those markets are being a little bit more affected than the more affordable areas.
Okay. So yeah, over 600,000 is going to sit on the market longer than under 600,000.
Right.
Makes sense.
Yep. Well, cool. Is there anything else that you can think of that you're seeing with buyers in the market right now that they may need to know or take into consideration, or maybe fears that they may have that they shouldn't have?
Well, number one, I always encourage folks to just get the facts, right? Mm-hmm. So especially if you've never purchased a home before, it's been a long time since you bought a home, things change all the time. And don't try to make decisions off of what you think you may know, right? Because you don't know what you don't know. Call an expert like myself or someone that you trust in the lending industry. Talk it over. Tell us your goals, your plans, your dreams, your wishes when it comes to buying and selling real estate, and let us provide the facts that can help that person make a wise and informed decision. All right. So that would be step one. And step two, and this is more to my first timers, is don't be scared. It's not as hard as some make it out to be to purchase a home, right? It's not as hard to qualify. You may be very surprised at how much you can qualify for and how little money down you have to have and how affordable the home might be. Because if you buy into this narrative, like we kind of touched on earlier, that it's just impossible to buy a home. Well, it's not. You just have to have a strategy. And maybe it's not the right time for you. Granted, but let's develop a game plan together. If this is something you want to accomplish, then what do we need to do? What steps do we need to take today to make that possible in the future? And how long might it take? And that is something that, a good professional lender that's been doing it for a long time can help guide a new buyer in making those decisions.
And one of the things that comes up for me is that it's never too early to start having those conversations, because I'm thinking about the folks that had conversations last year that are on our radar and that we're able to go back and say, hey, I've got great news. I think the numbers are working out for you a lot better right now than it was back then. And without that, we wouldn't have known, that information to be able to tell them that good news.
Yeah. Isn't that fun? I mean, we've got dozens of those buyers that over the years that you and I have been working together, where it took them a year or more of just getting things straight, getting themselves in a position where they were comfortable making that decision, making that move, often from other states to Georgia. And I don't think you can have those conversations too early, right?
Yeah, I agree.
We don't always have to pull credit or do an application or get all involved in that. Let's just have a conversation.
Right. Yeah.
Let's just talk about where you're at and where you want to go and develop a game plan to get there.
and is especially helpful and even more important, I would say, for if you're self-employed or you have a unique income sources rather than later, because you're masterful at being able to look at the big picture and kind of see how things can be finagled or some things that might need to be done to set us up for success.
Yeah. There's two big things that can, I won't say derail, but can be large speed bumps in the mortgage process, that the earlier we can be aware of those speed bumps that we have to navigate over, the better off we'll be. And one is the self-employed buyer, or buyers who a good portion of their income comes from some type of incentive like commission or bonus or overtime. We want to talk through what that means and how that's different in qualifying compared to just somebody who clocks in and clocks out every day. And two, folks that don't have their money in a traditional bank like checking savings account. I am talking to people, it feels like daily, that just have buckets of cash at home and they want to use that for their down payment. And unfortunately, the laws don't allow for that. You can't bring cash to an attorney's office to buy a home. It has to be, the term we use is seasoned in a bank account to be eligible to use for a real estate transaction. So the earlier we can start tackling some of those little issues, then the better off you're going to be and the better financing package you're going to be able to obtain.
And the way less stressful it's going to be.
Yes.
So
please,
yes. I think that's the biggest thing is that help us help you, you know, that kind of saying, and that we see this stuff all the time, and it shouldn't be something that maybe I think some people just put it off because they don't want to deal with it, or, you know, they feel like it's a hassle. And yet I promise you, it's going to make your life so much easier, and you're going to be thankful that you did it.
Or they're afraid of bad news. A lot of folks are afraid of bad news.
Yeah,
and,
I can see that.
And if they call me, they're not going to get bad news. I don't give out bad news. I don't tell people, no, you can't buy a house. I'm going to tell you how you can buy a house, because I don't believe it's no for anybody. Everybody has the opportunity. We just got to get on the right path to get there. So don't be afraid to call and get the facts so that you can make the right decisions. Yeah,
that's smart. Well, thank you, John. Thanks for joining us tonight. And you provided a lot of great information. If you want to get in touch with John, reach out to us. We'll connect you with him. John and I have been working together for 7 years now. 6, 7 years.
Wow.
Yes.
That's great.
And you're my longest vendor relationship in real estate. So you've made it this long of keeping my clients happy and keeping me happy. And that's very, very, very important. So so John is fantastic, super smart. Thank you everyone for joining us. Make sure you've liked and subscribed to the channel. We put out videos every single Monday about what it's like living around here. And you can follow me over on Instagram to keep up to date every single day on what's happening here in the Metro Atlanta market. So thanks for being here, and we will see you next time.
Yeah. Thanks for having me. Good to be on.
Bye.
Bye-bye.